You talk about being, the best at extracting gold, but are you the only player in town? I know you've been on it 9 years, but your focus is, creating cash. But have you done the analysis to see, do we bother to go beyond the 9 years? What's the cost us? What's the capital required to do that? Talk to me about the future. You got, obviously Sibanye is one player, and I know you're South Africa focused, but it's one player. There are hundreds of millions of tons of tailings in South Africa. What's the competition like? Hello and welcome to Crux Investor. We spoke earlier today to Niël Pretorius. He's the CEO of DRD GOLD. They're a tailings company in Johannesburg. We discuss a variety of topics. Look in the description below to see what those were. Click on the relevant timestamp. That'll take you to that part of the video. And if I could ask that you click the button in the corner of the screen to subscribe to our YouTube channel. And if you want to see more videos like this, click the notification bell. So let's hear what Niël had to say. Good morning, Niël. How are you?
Well, thanks. Good day.
So you're speaking to us from South Africa. Lovely warm South Africa today.
Yeah, it's summer down here, so it is a typical summer's day in Johannesburg.
Beautiful, beautiful. So you're going to tell us today a little bit about DRD GOLD and what you've been doing. So can we just kick off with a 1-minute summary initially, please?
The company's been around since 1895, and it was one of the pioneers of deep-level underground mining in South Africa. It's come full circle now, and it's focusing exclusively on the recycling and the remining of mine tailings, both around the Johannesburg area and now recently also in the Carletonville area. So you could say that we're mining South Africa's mineral wealth again.
Right, okay. So just again, tailings, we've had a few tailings companies on. I think it's sort of reasonably well understood. Perhaps can you give us a sort of basic overview of what it involves, certainly in the context of how you are mining?
Yes, certainly. So in South Africa, the typical gold content in tailings is between 0.27 gram per ton to about 0.36 gram per ton. So the guys who mined before us did a pretty good job of taking out most of the gold. But the amount of stockpiled resource from our perspective is just vast. There's several 100 million tons of material. So by setting up plant infrastructure and logistical capacity and tweaking your metallurgy in such a way that you can actually get into almost nano-extraction, you could still make a business out of this. So we're at the ultra high volume side of the equation on the one hand, and the nano-extraction side of the equation on the other end. That's the combination. South Africa is perfect for that because, as I say, we've got hundreds of millions of tons of material all over the Johannesburg landscape that we can access and recycle.
Right, and what type of process do you follow? I mean, you're looking at some of your presentations. It seems almost very simple process in a way, but as you say, with sort of nano extraction, it can't be that simple. Can you sort of get into a bit of the technical detail for us?
Yeah, the setup needs to be detailed. So the mining itself, it's getting the material there in sufficient quantities and also in the right state. So your densities have got to be exactly spot on. And we do that by mixing the tailings with water, slurry format, and then it gets pumped. We have a network of pipelines that feed into 3 separate plants. And there it goes through your normal carbon and leach process. So cyanidation, and then settling onto carbon, elution, and then zinc precipitation. Zinc precip is the process that we prefer over electrowinning because we could then batch treat solution and we could also up the volume. It has much more capacity than your typical electrowinning process. Right. The magic in the process lies in I think the key differentiator lies in the setting up and maintaining the plant in exactly the correct configuration. So over and above delivery at the required rate, you need to make sure that your key drivers are set up in such a way that you keep that plant within range, and you do that proactively. If you're going to be reacting to what you're seeing in the plant, you're going to run into some difficulties. You'll never get that plant into steady state. And that you do by way of ongoing monitoring. So we have 40,000 data prompts that take place at any given point in time. These get collected by way of my software. We have a software program for that. And then the information is packaged in such a way that you can see exactly where you are in terms of each of your key drivers and parameters. Make sure that your plant stays within it. So that's really it. It's not complex or difficult, but you've got to set it up just right and then keep it in steady state.
So this is a logistics exercise in essence, and you're dealing with presumably not only millions of tons of tailings, but millions of tons of water too. So you need to control that environment. So is there anything proprietary about what you do? You say it's easy, but has this technology been around for a while? What are the risks?
I think it's simple. We found out that it's not easy, but it is simple. To understand how it works, it's not difficult. To keep it in steady state, that's where the challenge comes in. Right. And I think the typical way of running a mine and running a plant is one of, so you do have systems, but it's almost done intuitively, and it's more often than not it's done reactively. And the difference here lies in just the application of existing technologies, software combined with engineering technologies, and setting it up in such a way that you can proactively manage your key drivers to remain within range. That's really where the key difference comes in.
Okay.
And to do proper diagnostics in terms of where things are going wrong, slightly off course. It also enables you to do very precise dosaging, because if you multiply everything by 2.5 million every month, because that's our tonnage throughput, every penny multiplied by 2.5 million, multiplied 2.5 million times, it ends up being a big number at the end of the month or at the end of the year. And from that perspective, it's important to ensure that you optimally take advantage of every single ton that goes into that plant, and that you do by making sure that it's set up in this way. Absolutely.
We'll talk about some of the numbers, which I think you state quite clearly at the end of your presentation, because it's all about margins when you're processing at that volume for sure. Can we talk about the business model? Because you talked about, obviously it's got a history of mining, underground mining, and South Africa is well known for this. When did you guys make the move into tailings, and why?
Well, it was gradual. The company bought the old Crown Gold Recoveries, I think it was in the late 80s. It may have been in the early 1990s, just before I joined the company. I joined in 2003. And it was a small tailings retreatment business at the time, combining with various underground mines in South Africa, and also some mines offshore in Papua New Guinea and in Fiji. What became apparent, though, is that our underground assets were sort of at the lower end of the quality range. They were old assets. Mm-hmm. They'd been around many, many years. At one point in time, they were very lucrative, but they'd reached maturity. And we started exiting those and focusing more on the surface retreatment. And then we were very fortunate that AngloGold Ashanti decided to abandon surface retreatment in the Johannesburg area. And their plant came up for sale, the old Ergo plant. And then we managed to just put together the different bits of a new surface reclamation business. They'd mined out most of their resource, but we earned a lot still on the East Rand, on the old DRDGold footprint, and also towards the central and west of Johannesburg. And we managed to combine all of those and bring new life to the Ergo footprint. That's where it started. That was about 10 years ago. 8-9 years ago, maybe. And then, of course, recently earlier this year, we also commissioned our new project, the Far West project, which we acquired from Sibanye-Stillwater.
Okay, so, and just before we get into both those, because they've got different dynamics going on there. So your plan is, obviously, you've got the skills in-house to deal with tailings now. You're no longer mining in any way, shape or form, and you've set up to deliver that. So what is the game plan here? You're a reasonable sized company now. Yeah. Growth plans, I think you would say the Sibanye deal allows you to make that next step. Can we talk about? Let's talk about Ergo first. Ergo is how long have you had that, and how long have you been operating Ergo?
It's been about 9 years, I would imagine, maybe a little bit longer.
Right. Okay.
So that became the let's call it the center of gravity of the operations. And a lot of the things that happen within the business happen sort of around Ergo. Ergo was the big enabler. And I think what Ergo taught us, because it is a very high volume, low recovery plant, low recovery in the sense of the actual yield. The yield's about 0.2 gram a ton on a combined basis. What it really taught us, I think, over time was how to develop the system of information management to make these things more predictable. And I think that's the technology that enabled us to tackle the Far West operations as a first step towards growth.
Yeah.
So Ergo it remains a very important, probably the most important part of the business in terms of size and scale and leveraging off its capacity and its potential, also years of developing intellectual capital. But it's certainly now enabling us to leverage that package of proprietary information, so to speak, or developed information, so to speak, and apply it somewhere else. And we can go into these things with more confidence because I think we have a better understanding because of better management of information. And I think from Far West operation, it's turned out really well for us. The project has come around really nicely. And we're hoping that this would open new opportunities for us, also within the context of our relationship with Sibanye-Stillwater, because they have an abundance of assets which at this stage is yet unrecognized. And I think that would be a good next step for us.
For sure, but just on Ergo, so it's in terms of, I think, I apologize, I don't quite know the parlance here, but in terms of the life of that mine equivalent, how much longer can Ergo carry on for, and will it continue to deliver at the same sorts of rates that it is now?
In terms of its current engineering and capacity infrastructure, about another 9 years.
Right.
The limitation on its life is though it's not availability of resources. There's enough for another 20 years for that matter, but there's going to have to be some enhancements in terms of deposition capacity. The tailings deposition facility that we're currently using is going to have to be improved. It's going to have to be extended for that matter. And we're also going to have to do some tweaking in terms of volume throughput at the plant itself, because at some point or another in future, 4 or 5 years from now, the feed grade going into Ergo is going to drop by about a 0.04 gram a ton. And that may require higher volume throughput, which will require a slightly larger tailings deposition facility. So that will be the catalyst to extend it beyond the 9 years that we're currently planning.
Right. So, but have you done the economics on that? Have you done the study? I know you've been on it 9 years, but your focus is, creating cash. But have you done the analysis to see, do we bother to go beyond the 9 years? What's it cost us? What's the capital required to do that, and what's the return on that? Is that a process you go through?
We're actively working towards that. So the increase in size in the tailings deposition facility, that's pretty much a given. It's a licensed site, and we're tweaking some of the license conditions. We're engaging with the regulator in terms of some of those license conditions. But in terms of current economics, if you look at where the gold price is now, what our recovery efficiencies look like, existing available technology and so forth, it is definitely something that we would want to take forward.
Okay. I mean, I don't want to talk about it yet, but obviously gold prices had and we will come back to Sibanye, apologies, but just while we're segued onto gold price, obviously that's had a very, very positive effect for anyone producing gold since beginning of July this year, yourselves included for sure. Do the economic calculations that you're working towards for Ergo rely on, what is the minimum price for you to be able to say, I'm going to make that decision to spend that capex on Ergo?
I think what it does at the moment with this margin is it's making the capital far more affordable. Sure. In the sense that we could set up the capital infrastructure with existing cash flows, or fund it mostly out of existing cash flows. We won't have to go and borrow a lot of money. We won't have to go and issue a lot of shares in order to do this. So I think it's this could be the enabler or the catalyst for us to do that extension without having to rely on a gold price that is similar or higher than what we currently have. The gold price could be anything to 15 to 20% lower than what it is at the moment, and that project would still be a good project.
Okay, so that's the number I wanted to get at. So if the gold price was 15-20% lower than it is today, it would still be economically viable for you to do that. I know you've got no debt, you're producing a lot of cash, you've just issued quite a large dividend to shareholders, and as you have done for the last 12 years, that's all impressive. So financially, you seem to have your house in order, but I'm trying to understand the thinking. How do you make the decision between saying, let's invest into Ergo versus a new project like Sibanye, and as you say, they've got a lot of other assets which may be a better use or application of your cash? I mean, what are those discussions like internally with the board? How do you make that decision?
So we're looking at a cost of capital of about 15%. Mm-hmm. So obviously that's our minimum threshold. If we don't see that, if we're not going to get at least that 15% return on our investment, we're not going to go anywhere near that. Ergo clears that hurdle quite easily. Okay. Beyond that point, it's really a matter of prioritizing based on which one is the most attractive. We do take a very conservative approach to capital expenditure. We spend our capital not on the basis of what we hope the gold price will be, but on what the gold price is. Obviously, at the moment, slightly lower than what it is because it's exceptionally high levels. But we don't spend capital on a hope. We spend capital on the basis of fundamental analysis of what the business is capable of yielding. And because we take full exposure to gold price, and we think that's one of the things that appeals to the market, the fact that we do provide very steep gearing to movements in the gold price. We also want to limit interest to an absolute minimum, because while you can manage costs, and our costs are pretty modular in its design, so to speak. We can switch off big chunks of cost when we go through a dip in the gold price. So interest doesn't work like that.
Can you tell me about that? When you say you can switch things off quickly, because when you make capital commitments, most, like in a mining company, it's very hard to switch that off. You've got to have a view of what the future of the gold price looks like to be able to make large capital plays. You're saying, no, we can actually turn that off at will. Is that what you're telling me?
Well, depending on just how challenging your circumstances are. So there are certain sections of the plot that are worth keeping on at a certain gold price. And you can work out exactly how many additional kilos of gold you have to produce in order to keep that part of the plant going.
Yeah.
Also certain areas that you're mining. So at the moment, we're mining a healthy blend in terms of sustainability. We're not picking out the eyes of our resource. We're making sure that what gets into the plant is what's going to give us the longest life at healthy margin. We're not chasing margin and then let tomorrow take care of itself. So those are the sort of optionality. We've raced ahead in terms of some of the environmental programs that we're running. So if there is a short-term deferral of let's say 3 or 6 months on some of those programs, it's not going to cause damage to that, and it's also not going to cause significant nuisance to surrounding areas and so forth. So these modular chunks of cost that one could move around a little bit, which you don't necessarily have in an underground mine. Now, interest doesn't work like that. If you have big loans, you cannot move your interest around. And as a consequence, we do take a very conservative approach when it comes to planning of capital projects. And in terms of current gold price, when we look at the future of the company and the increase in size of our infrastructure, deposition capacity, and so forth, current margin is very relevant within the context of planning that out going forward, because this will enable us to maybe accelerate some of those programs, bring them forward. You don't want to pay income tax now and interest later on capital development. Bring it forward a little bit, spend the money once, and you're not unnecessarily increasing either your tax or your debt liabilities. But make sure that it fits into the bigger picture, that you're still not, you're not chasing a dream, you're chasing reality, and that within the context of where we believe gold price might go going forward, you still have a sustainable business.
Yeah, you've also got to be reasonably conservative here in a way, because gold price, it's back up. Don't know for how long. So you've got to again get that balance between saving money for a rainy day, when times may be tough. I don't know what your cash balance is like. I know you've got no debt, but what is your cash balance actually?
Well, at the end of September, it was just over 330 million rand.
Right. Okay.
With about 130 million rand locked up in working capital, so it's a very healthy cash balance.
Right. Okay.
Right, but you're right. Money has a way of disappearing if you don't look after it.
Well, yeah, this is my point. You've got to get that. But again, I'm really fascinated by the way that boards think. Some are a little bit more gung ho than others, and others are a little bit more conservative or cautious because they've seen the cycles in the commodities space. Gold's not impervious to that. Times are good now. Since July, it's been even better for you guys, for sure. Producing more margin there. And it's a case of understanding what either you spend money because you think you can create more value that way, or you park some just in case. And I just wonder, where you sit and that kind of thinking.
We do three things basically. So we do have a peep in the rearview mirror.
Mm-hmm.
So what maybe did we not neglect, but what is there? What sort of lingering, what sort of legacy issues could there be, considering that we've cleaned up 24 different sites? Are they all cleaned up to satisfaction, or are there some lingering little issues that might catch up with us because there is a bit of capacity now? So a bit of a peep in the rearview mirror. Then there is an assessment of our current situation. What is it that we are doing now that with a little bit of capital and a little bit more focus and in an accelerated environment, we could improve in order to ensure that we are more resilient and more robust going forward? And now let's take a peep into the future. What is it that we think we're going to be doing going forward? What are the apparent, what's the roadmap going forward? Our objective is to mine as much of this resource as we possibly can. What is it that we can do now that provides optionality without getting us stuck in a corner or overextended in terms of financial obligations, et cetera, that we could maybe bring forward, or that we could do it in a way that enhances flexibility and optionality, and all those MBA terms that you get peppered with by consultants. But we do take a little bit of a peep into the future as well and say, right, but we're now in a position to do something. So how do we go about it intelligently to bring the future a little bit closer? Okay,
so let's talk about Sibanye, because that is that's a meaningful company. It's a meaningful partner or shareholder. You've done a deal. Can you tell us about the structure of that deal with them, and what their involvement is? Because I think they've got some options themselves, which they may or may not take. So can you just explain to people what that structure of that deal looked like?
Yes, certainly. So they have, when they acquired this parcel of assets out of the Goldfield stable, amongst those were some of the highest grade mine dumps in South Africa. Mm-hmm. Highest grade in the sense of what you're also able to recover from them. There's some of these refractory ore bodies that have high grades, but it's the reason why the grades there are so high. These are dumps that came into being because exceptionally high grade ore bodies, benign ore bodies, were mined over several decades. And I think that they were looking at somewhere or another unlocking the potential of this asset, and they were looking at various options. So we were very fortunate to, at the right point in time in their thinking, approach them with the idea of maybe this would be a good fit for DRD Gold, considering where the team has managed to get in terms of technologies and information management, et cetera, et cetera. And they agreed, but they weren't just going to give it away. So they took a 38% stake in our company in exchange for 250 million tons of material. It doubled our reserves, but it also came with existing infrastructure that we could, by way of very minor tweaks, get going in a very short period of time. I think we started in August of last year, and we were in production by February. We've basically done full commissioning from December through to the end of February, beginning of March. We were in full flight, and I think we hit signature production in about May for design. In about May. So the structure is that they've got 38% of the company now, and they could, by way of a subscription for new shares, take that to 50 plus 1. And they need to do that before the end of February of next year.
Okay.
And we think that there's a good chance that they will want to do that. I think they will want to take a bigger chunk in the business. I'm not entirely convinced that the company's recent operating performance is really reflecting in the share price. I think what you're seeing in the share price is maybe the gold price movement, but maybe not necessarily the operating performance of the business. So it's a good time for them to exercise the option. it's not a bad time for us because it's also going to come in with about $1 billion in additional capital flowing into the business, which too can be applied towards the development programs that we have both for Ergo and now also in terms of the Far West operation.
Okay, so this comes back to my question about the business plan. Obviously, with Sibanye as a new shareholder partner in a way. I know sorry, are they an active partner or passive? They let you get on with it, do they?
Yeah, no, they don't interfere. Look, there's no doubt in my mind that they will interfere when we start messing it up. But so far so good. They've been a passive partner.
Okay,
and supportive.
Okay, so coming back to the business plan, which is, so if you've got someone as large as them with the ability to come in and get 50 plus 1, what does that mean for you, and what does it mean for them?
Look, I think for us it means more opportunity. It means that we can grow the business, and we can do that without diluting the economic benefits of existing shareholders. And then maybe this is something on which I can elaborate just very briefly. Something that was an important consideration for us when we did the Sibanye deal was that we were going to dilute our existing shareholders out of 38% of the cash flows of Ergo. And we've been a dividend-paying company now for 12 years. So were we going to acquire something where the 68% stake in the new business was going to make up for the 38% dilution of the existing business? And what we saw was something that actually did more than that. There was more than an adequate offset and value add in terms of the new asset coming on board. So clearly everything that we do going forward, it will be a consideration. Are we diluting existing shareholders, or are we adding value in terms of tangibles? And I'm not talking about sort of strategic fantasy flights here. I'm talking about real value. Is the value of the share price going to be higher, or will the cash flows, the free cash flows per share, benefit from the transaction in the near or medium term? So obviously there's going to be some period of development in between. So if it qualifies, if we can tick those boxes, I think we would want to move forward on assets that by and large have become or that are invisible within the context of the Sibanye stable. You're not buying Sibanye-Stillwater because it has several 100 million tons of platinum tails. You're buying it because it's got mines with very, very attractive underground ore bodies. And I think those are the sort of assets that we would want to take a long and a hard look at. It will enhance our profile as a producer. I think it can assist us to further build on our brand identity of a legacy cleanup operator. That also, but that comes with healthy financial returns. So there's a good ESG element built in the story as well that I think we've been convincingly building up over time. And at the same time, from a Sibanye perspective, it will mean the unlocking of value that is just not recognized, that just disappear sort of within the context of the larger portfolio assets that they have.
So I guess there's a few moving parts there. There's obviously with Sibanye coming on, they had a tailings operation, which is that correct?
The one that we bought was there was nothing. It was the assets. It was the dumps and the concept.
Just the asset. Got it. Okay. So there's that component to it. There's everything that you've learned from Ergo, and being able to apply to the Sibanye asset. Did you inherit any data about the tailings? Had they done any work? Are you starting slightly ahead of the curve, or are you having to start from scratch?
There's an enormous amount of information that they've gathered over time. This started in the Goldfields days when they were talking about the 6th shaft that they were going to develop. So there's an abundance of information, and it's good information that we could use. It wasn't an operating asset when we bought it. We had to spend capital to get it to operating state, right. But there was a lot of good information that we could use. Interesting.
And is that the same for some of their other tailings projects, which I know are not part of the stable yet, but if they take up this option, have you got a sense of the scale of what it could mean, the scale of the operation opportunity and what that could mean for you guys? I know it's early days, but you must have had a peek.
Yeah. Now look, the rest of the information that's out there is maybe not as detailed and not at the same level, quality level, as the information that we saw at the Far West operation, because these are not necessarily considered projects, But remember that you have decades of records of tail grade coming out of plants.
Yeah.
And many of these assets have in fact been drilled. We know that there are programs underway for further drilling of these assets. So more and more information is being gathered as we go along. It's not quite at the same level. It's going to require some additional verification. But, these things are on surface. It's not that hard to get verification. It's not that tough to do the test work and get a sense of the metallurgical response of these reports.
So it's relatively cheap, relatively quick. But you talked about something a second ago, which is about the word rehabilitation. That also to me says removal of liability associated with these tailings. And that's obviously a big part of Sibanye's thinking. Has that influenced their ability or your ability to, negotiate terms? Is that part of it?
Look, in terms of the Sibanye assets that we acquired, it was a business unit, so it had intrinsic value. You could actually, there was a business plan around it.
Okay.
In terms of other assets maybe belonging to other companies, their tailings are by and large, remember tailings is mine waste. It's thrown away. And if you don't have plant infrastructure, and if you don't have sufficient deposition space, and all the other odds and ends, the bits and pieces that you're required to retreat those, it stays just that. It stays waste. It doesn't have intrinsic value. And because of the volume scale required in order to run these things efficiently and profitably, it's a lot of capital that's required up front. And you then make mistakes, and invariably they do make mistakes. They overestimate the recovery efficiency of the material. Also, they're going to get 75 to 80%, maybe even more. If you get 55%, you're in good shape. You're running a shape of an operation. So they get into trouble. So when you look at other assets that don't form part of an existing portfolio of assets that haven't been dealt with, developed as an asset, as a producing asset, then typically they are just waste. And then what you want to do in those situations is offer yourself as a solution to an environmental problem, as opposed to say, let's do a commercial deal. You're not writing checks for those stamps. You're taking over an environmental responsibility. And within the context, the renewed context and focus on ESG, which I think investors globally are taking more and more seriously. These solutions are good solutions to have as a corporate, especially if you know that you're not, by handing over these assets, you're not throwing a small boomerang that's going to come back at you as a big boomerang. This is actually a complete solution. And I think that's what we would maybe also want to work towards over time, is that we could become a credible and reliable environmental solution to ESG issues and environmental issues, et cetera, pertaining to tailings.
Oh, absolutely.
We've got a lot of experience in that regard. I mean, last year alone, we handed back 135 hectares of land in the Johannesburg area that was previously sterilized because they were covered with tailings. We don't offer 100% sort of a turnkey solution to a 100-year legacy rather, but bit by bit, incrementally, you could actually start sensing and seeing, witnessing, seeing with your own eyes the impact that 20, 30, 40 years of tailings reclamation is starting to have on this landscape.
No, it's very impressive, and you're right, it absolutely is important to investors. I'm so intrigued with, you handed back the land to, because when you negotiate a contract, you're negotiating the ability to extract certain minerals from a tailings pile, and these piles are huge, these mountains sometimes, but you don't actually own the land. That belongs to, right, so who did you hand the land back to around Johannesburg, for instance?
Most of the land in and around the Johannesburg area is, in terms of agreements that were entered into in the early 90s, the 1990s rather, where the tailings and the land were separated. And there's a company in Johannesburg called iProp, and they own most of the land holdings on which many of the tailings that we treated and that we're returning now were situated. In the Far East Rand, on the ERPM footprint, there we actually own most of the land. And now in the Far West Rand, Carletonville, we also will be owning most of the land. So I mean, I suppose the value add from the current executive's perspective is not so much that there is land to develop. The value add is there was a dump sitting on land that could be used otherwise. Yeah. By removing the dump, there's an unlocking of other value as well.
No, that's that, again. I'm just fascinated by how you structure these deals, because it's not just necessarily about cash extracted from the tailings and removal of liabilities, etc. But there's other ways that you can remunerate yourself, which have different tax implications and for the future, positive tax implications in the sense you take land as part of the payment for the reclamation component. So again, I just wanted to understand if that was part of your thinking. Sounds like it is. So
yeah, you're right. Structures, yeah.
Yeah. So talk to me about the future. You got, obviously, Sibanye is one player, and I know you're South Africa focused, but it's one player. There are hundreds of millions of tons of tailings in South Africa. What's the competition like? You talk about being, the best at extracting gold, but are you the only player in town?
No, there are some other players as well. I think more and more companies are recognizing the value and the relative simplicity of setting up these structures. They're finding out that the operational angle is slightly more complicated, but you can get there eventually by applying your mind. In terms of our own capacity, of just the size of the management team, of what we're capable of doing, I think also very importantly the value system that we want to take to each of these operations. We are taking small steps at this stage. We obviously want to make sure that we take full advantage of our existing footprint in and around the Johannesburg area. I think we are more and more becoming a player in terms of social capital. We're more and more becoming a player in terms of environmental capital. And I think we want to see that through. We don't want to work on our reputation and our brand identity only to abandon it prematurely. So that takes a lot of focus. Same applies to the Far West Rand. That's a little bit more remote, and it's a little bit more concentrated. So I think expanding towards full capacity there is maybe going to be easier than in the Johannesburg area itself. The platinum potential, or the platinum group metals potential of Sibanye, that's going to take up a lot of time and effort if we are given an opportunity to do that. And we basically covered the next 5 years in our company's existence. So we do want to make sure that everything we do to a certain specification and to a certain standard. And we're not going to go into a sort of a heavy deal-making rush here and drop more balls than we can field.
Okay, so steady but sure, based on what you know. But as you get bigger, it gets harder to deliver the types of, returns as a percentage of what the company has been doing. You think it's going to get easier to deliver dividends to shareholders because you're going to be dealing with larger projects? I mean, how do the numbers look to you going forward? Or what do you want them to look like going forward? Because I'm trying to say, new investors coming in, very successful to date. How do they keep this going? Where's the growth coming from? What's the answer?
Yeah, look, I don't think it's going to be paying dividends at the moment with the gold price where it is, and with the way that the business is set up as it currently is that
it's easier.
Not a concern for the world.
Yeah.
So I think it's going to be hard to maintain that sort of dividend return. It's going to be harder to maintain that sort of dividend rate. And I'm told that there's such a thing as a growth dividend. I've yet to be convinced that it really exists. Maybe it's just how executives convince themselves that it's a good thing to do a deal that won't have much of a financial return in the short term. Maybe I'm being naive or really conservative, but we'll investigate. We'll have a look into that as well. What we do want to do, and I think that's probably the more important consideration, is that we do try to run this business towards a very specific set of values. Commercial values, social interaction, environmental interaction, compliance, etc., etc. And we don't really want to cut corners on any one of those. So we'll grow at the rate at which we could ensure that we can transplant those. And they're not, way out values. They're simple, straightforward, in my view, the sort of values that gives you the best chance of achieving sustainability over a long period of time. And we want to make sure that before we move on to the next asset or the next project, that those values have been embedded and that they become institutionalized and that we could move on to the next thing. Because with every project, with every asset, you also get people. And we were delighted to see how how seamlessly the people that we integrated from the Sibanye stable, and they were plant workers, almost sort of on the periphery. They were working in a plant that was about to be closed, and it was just delightful to see how easily they integrated into what we were doing, and they're moving forward with this thing and identifying with our brand, with our identity, with what it is that we want to achieve and how we want to achieve it. And I think that's going to be for us an important requirement going forward. Happy that we've got it embedded here. We will look at the next one, because with that, I think with those sort of with that approach, we're also giving ourselves the best chance of ensuring similar sort of returns to the ones that we get now.
Well, yeah, absolutely. And when times are good, when there's lots of money, people, your recent dividend was what, three times larger than your previous dividend? Is that right?
Yeah,
right.
At least, yeah.
Right. So you've been very generous back to the shareholders. Have you been very generous to yourselves? Are you bumping your salaries and remuneration packages up too?
Yes, the salaries are sort of adjusted in accordance with inflation. So we have inflation related salaries. Of course, the bonuses were really good this year. Mine was slightly lower than the previous year, but there were other dynamics that came into play. And our KPIs are assessed on the basis of a broad scale of measurables and parameters. There's a sustainability aspect, the safety aspect, the environmental aspect, compliance, etc., etc. And because we take full exposure to gold price, you don't necessarily get incentivized based on revenue. It does play a big role. If there's not enough revenue, there's no incentive. But we do take a look at what we planned for the year, whether we sort of came in terms of costs and production and throughput and so forth and so forth. So it's a matrix that doesn't only reward happy financial times. What was really attractive for us this year were the longer term incentives. Personally, I've been outside of the long-term incentive scheme for many, many years, for the first 8 years of my tenure. Recently, I was brought into that, and I must admit, it was a very, very good year for most of the executives in DRD GOLD this year, in terms of the long-term incentives.
Absolutely, but
we're certainly not underpaid, definitely not. We're very fortunate.
Okay, yeah, and you're making money. You're debt free. Like I said, your finances, your house is in order on that front. I mean, is part of that remuneration assessment based on share price?
Yes, very much so.
Right. Okay. And obviously, it's been a good second half.
An index of other gold mining companies.
Yeah. So it's been a good second half to the year. So that helps for sure.
Very much.
Well, Niël, thank you very much for that. That's a fantastic introduction to a space which I like, tailings recovery, and for all the ecological reasons too. But you guys are making money, which helps. So I appreciate you introducing that to all of our viewers, and we'd love to stay in touch. Let us know how you're getting on, especially with the Sibanye deal. It sounds like a great time for you, and we wish you well.
Thank you. Thanks very much for the opportunity.
Thanks very much for watching. We hope you enjoyed that. And if you did, please click the button in the corner of the screen to subscribe to our YouTube channel. You can also catch us on our website, cruxinvestor.com, and Cruxcast, our podcast series. Plus, most days you can catch us on LinkedIn and Twitter. We'd love getting your feedback, so please keep that coming, and we'll speak to you again soon.